Let's move on. Journal entry number 3. Okay, so when we look at this, guys, they have debited deferred tax, credit income tax, with a 450,000 Rand times 28% recognition of deferred tax for the current year. Now, you will remember that they have indicated to us that this is research costs. Guys, immediately, you know, research costs should be expensed. Therefore, there should not even be a journal entry. Right, now what do we write down? We include our heading. This is our journal entry number 3. And we need to state that research costs should be expensed and not capitalized. Therefore, if this is expensed, there will not be any temporary differences. And based on the fact that there's no temporary difference, there cannot be any deferred tax. Pretty straightforward, guys. Research costs expense, not capitalized. Therefore, there is no deferred tax, and this total journal entry is wrong, incorrect. Let's move on to journal entry number 4. Now, before I work through this journal entry, I'm going to refer you to 3 important paragraphs in IS 12. Okay, so guys, you do have your standard with me, but please bear with me. Let's just quickly work through this. I will have to read through the paragraphs and explain them to you. Okay, so when we look at paragraph 34, it indicates to us that the deferred tax asset shall be recognized for the carry forward of unused tax losses and unused tax credits to the extent that it is probable that future taxable profits will be available against which the unused tax losses and unused tax credits can be utilized. Now, this is our important sentence. Remember, we will only recognize our deferred tax asset should it be probable that there will be future economic benefits to be able to utilize, to use this deferred tax asset. Then, when you look at paragraph 37, at the end of each reporting period, an entity reassesses unrecognized deferred tax assets. Now, remember, when will an unrecognized deferred tax asset exist? When they were uncertain in terms of future profits. Then there will be a deferred tax asset, but they did not recognize this unrecognized deferred tax asset. The entity recognizes a previously unrecognized deferred tax asset to the extent that it has become probable that future taxable profit will allow the deferred tax asset to be recovered. Remember, if we recognize a deferred tax asset, that means that there should be future income to be able to write off that deferred tax asset. Therefore, now, in the following year, therefore they indicate to us at the end of each reporting period, if we now identify that there is a deferred tax asset that we did not recognize due to uncertainty, we may now recognize that deferred tax asset, but only to the extent that we will be able to recover that amount, right? Now, paragraph 56. The carrying amount of a deferred tax asset, look at this is now from the other way around, shall be reviewed at the end of each reporting period. An entity shall reduce the carrying amount of a deferred tax asset to the extent that it is no longer probable that sufficient taxable profit will be available to allow the benefit of part or all of that deferred tax asset to be utilized. Right, therefore, paragraph 34 indicates to us that we may recognize a deferred tax asset if it is certain that there will be future income to be able to utilize, to be able to use that asset. Paragraph 37 indicates to us that at the end of each reporting period, therefore, when you look at my timeline, let's say, for example, that this section here is the end of year 1. Now, at the end of year 1, they've recognized tax losses, right? But they did not recognize a deferred tax asset because they were uncertain in terms of future income. But now, at the end of year 2, they are now certain that there will be sufficient income. Then they may now recognize this deferred tax asset in terms of year 1. They may now recognize in year 2, but only to the extent that they are certain of the future income portion. Because remember, guys, at the end of year 2, our income of year 1 is now certain. At the end of year 2, it might be that they now have recognized profits. Therefore, if there's profits at the end of year 2, there will be certainty in year 2 in terms of the year 1 losses. Therefore, we may now recognize this deferred tax asset to be able to use this. And then paragraph 56 indicates to us, if we have recognized our deferred tax asset, let's say at the end of year 2, we've recognized this. And now at the end of year 3, it appears that there is no longer probable that sufficient taxable profit will be available to use this deferred tax asset that we have recognized in year 2. We need to, I want to make use of blue. We need to review this amount, this deferred tax asset. We need to review this. Right. Now, this is important. I have identified quite a lot of students still struggle with these principles. Please work through this, ensure that you are comfortable with this. Right. Now, let's have a look at journal entry number 4. Right. Let's work through this journal entry. Okay, so guys, we're going to go back to basics. For now, look at the narrative information in terms of the journal entry. It's the recognition of deferred tax, the movement of the unused tax loss for the year. Now, if this is the movement, remember this will be the movement from 20.17 until 20.18 in your deferred tax calculation. This is your movement section. Right, now they've indicated to us, guys, at the end of 20.17, they were uncertain about any future taxable income, but during 20.18, they now became certain. And then they provide us with a final tax calculation. Now, in terms of the final tax calculation, we are able to identify that there is taxable temporary differences, which we need to include in our deferred tax calculation. For 20.17, a taxable temporary difference of 50,000. Therefore, this taxable temporary difference will result in a deferred tax liability to be recognized. And then for 20.18, we have taxable temporary difference of 300,000, and this will result in a deferred tax liability of 84,000 to be recognized. Right. Now, remember, we now need to focus on the unused tax loss movement. Therefore, this will be the unused tax loss movement. I'm just going to indicate your tax loss and then our tax loss. Therefore, we need to determine what is the movement from 20.17 till 20.18. Right. Now, remember, in terms of IAS 12 paragraph 34, they may not recognize any deferred tax assets unless they are certain. Now, at the end of 20.17, they have recognized a taxable loss, 1.1 million. End of 20.18, a profit of 750,000. Okay, so guys, when you think about this, if I have a business and this year I recognize a loss, I would like to utilize and use that loss in the future. Therefore, I would want to use that 1.1 million in 20.18. Therefore, in 20.18, we first need to create the deferred tax asset in terms of the loss. You with me? And then we are able to use the 750,000 of the 1.1. Therefore, if we use 750,000 of the 1.1, the remaining amount will be 350,000 that we are able to recognize a deferred tax asset for, because they are now certain. Therefore, at the end of 20.18, we need to recognize the 350,000 deferred tax asset. And this is a value of 98,000 deferred tax asset. And for 20.17, guys, we have a taxable temporary difference. If we have a taxable temporary difference, we are able to recognize 50,000 of our unused tax loss against this taxable temporary difference, therefore a deferred tax asset. And now, when we look at the movement between 20.17 and 20.18 in terms of our unused tax loss, this movement will be the 300,000, and this will be 84,000. That should be recognized as a deferred tax asset in our journal entry.